This is going to help explain what's going on with S&P 500. The 5 biggest companies in the world: Apple, Microsoft, Nvidia, Alphabet, and Amazon. Actually, there's something on the right that will give the whole thing away, which is the price chart for the last 30 days. What do you see? Only Apple is in the green, correct? Microsoft, Nvidia, Alphabet, and Amazon are all down, and these are the biggest weightage to S&P 500. Only Apple is now above $3 trillion. Microsoft and Nvidia have slipped. So today, to understand what's going on with S&P 500, we'll focus on the 3 biggest companies. I'll show you key insights which will explain to you why you should stop buying S&P 500 only. Hi guys, welcome back. Let's start with Apple. Apple is right now the biggest company in the world right now as we are filming. But actually, its sales figures isn't that good. Let me show you what's going on with Apple in terms of its profitability. From 2020 to 2021, when COVID hit, sales jumped, correct? Maybe everybody was very bored at home and buying iPhones or had a lot of excess money, couldn't travel around the world. That's why iPhone sales went up. And then what we saw is that Apple's share price went up. But the curious thing is that Apple's share price has continued to go up despite its profitability flattening for the next 4 years ahead. If you see now, 2024's profit is even less than 2021. Zero or negative growth depending on how you measure it. Very surprising, correct? Because you think that Apple's profits are ballooning. And just in case you didn't know, iPhone sales are still the biggest component to its profitability. And US sales is the biggest, followed by China. And you know there's been so much mockery about iPhone. I'm an iPhone user myself, so I'm not the super tech savvy guy, don't know about you. But many who use Android always say the iPhone 15, 14, 13 all look exactly the same. Features good, but you see Android 10 times better.
Confirmed that Android has more innovations.
Fair enough.
We've used titanium long before. Better screen options.
Oh, yeah, totally.
So now, would you consider buying an Android or an iPhone?
Definitely iPhone.
You know the joke, right? And while some of us are still happy with Apple's products, the same cannot be said in China. China's sales for iPhone has reportedly dropped sharply in 2025, dropping 18.2%. Apple is now no longer the best seller phone over there. It has been overtaken by Huawei. So why do Chinese consumers prefer other smartphones? Firstly, Apple charges too high a price for features which Chinese rivals mostly match at a lower price. Actually, I think that the features for Chinese rivals like Huawei are even superior. Again, this speaking from an iPhone user. Never mind what I think, let's look at what Warren Buffett thinks. He has been an investor in Apple since 2016. Many times on this channel, I advocate for long-term investing. Warren Buffett's journey is something we can learn. He's held Apple for almost 10 years and is still holding some. But the key is some, correct? And let me explain this chart to you. On the left-hand side, you see that he started investing in 2016 and built up the position to a sizable amount of 1 billion Apple shares by 2018. At this point, Apple was trading at a price-earnings ratio of 15 to 20 times only. That low. And iPhone, of course, was still growing big. So from a price-earnings growth perspective, you realize that Apple was compelling back then. Then what happened after 2018? He didn't increase his position in Apple, correct? In fact, he started to trim bit by bit. And that was with Apple's share price climbing all these years. In the maroon dark red line, then something happened. The price continued to climb until it was 30 times price-earnings ratio, and Warren Buffett made significant reductions. He's of course traded and bought back some shares along the way, but you see there's roughly around 900 million shares that he kept. That was all the way until 2024. As I mentioned just now, Apple's profitability did not go up. On the other hand, share price continued to go up. This translates to a higher price-to-earnings ratio than ever at 40 times. In many perspectives, it could be argued that Apple has become too expensive. Is that the reason why Warren Buffett has cut? No one knows for sure, but his actions speak louder than words, and he has cut his stake significantly from almost 900 million shares to only 400 million. If he truly believed Apple will go up to the moon, why would he cut his stake, correct? And more curiously, what has Warren Buffett bought most recently? I've designed up a chart for you to see, and before I run through this, help me smash the like button It's taking our team hours to prepare this presentation for you, and I'm filming this late at night. I had a busy week, but I would still like to share with you some findings I see on the market that can hopefully benefit you moving forward. Thank you very much for subscribing, and thank you very much for smashing the like. So let me explain what does this exactly mean. In the yellow line, that is Apple's share. In the light blue line, there's S&P 500, and in the dark blue line, that is Domino's Pizza. Warren Buffett, as I mentioned just now, has sold massively in Apple. Not only that, he's actually sold away a small stake that he had, or rather Berkshire had, in S&P 500. And what he purchased was Domino's Pizza. Of course, not using all his cash that he had, but these were the moves that he made. Sell, sell, and buy. And coming to this, we'll be thinking, why is he so stupid? Why is he buying an underperforming company relative to Apple? Or just buy S&P 500? Why are you investing? Especially in dark blue line. Can't you see that it doesn't really grow? Well, maybe Warren Buffett knows something more than we do, and maybe that's where value investing comes in. As long as you buy something that has great value, over time, it will reward you. You won't know whether you outperform in 1 year or 2 years, and it may even underperform. But if you practice this often enough, you realize that you have a chance of delivering good returns to your portfolio. So with Apple cleared, let's move on to the second biggest company in the world right now, which will also impact S&P 500 massively, and that's none other than Microsoft. Let's start by seeing Microsoft's terrible 1 year performance. This is just a gut check because investing in Microsoft has been fairly popular. Just that recently it hasn't done well. Or rather, just that if you compare this to all other mega cap companies, this has been the worst. Microsoft is negative 3% even after 1 year. And the curious part is that all this lousy share price performance is despite its profitability going up to record numbers. From this perspective, Microsoft looks way better than Apple, correct? We're not looking at share price only. Share price, we can't control it. We look at the fundamentals and the profitability. If you own Apple as an investor, profits are stagnant, but Microsoft profits are growing up. So what exactly is impacting Microsoft's share price sentiment? Well, quite clearly, Microsoft is pouring a lot to AI and pouring a lot to building data centers. That capital expenditure has not shown results yet. Apple has not chosen to deploy its money that way, and maybe markets are punishing Microsoft for a potentially poor investment. We don't know yet. Or maybe the markets are seeing Microsoft's slow down in terms of profitability. They have guided that second quarter 2025, cloud business will have slower growth. But for me as an investor, I see Microsoft having way better value than Apple. You see that from a price earnings perspective, Microsoft trades at 31 times only, which is below its 5-year average, and more importantly, it has growth. Let me know in comment sections whether you agree or not. And with that, let's move on to the third biggest company that will impact S&P 500. And it's something that is so popular that I see many private clients' portfolio, and that's none other than Nvidia. Nvidia has been the market darling after Tesla. Tesla was until 2022, Nvidia is 2023 onwards until now. The baton has been passed, and maybe now Nvidia will be passing it on to someone else, maybe Palantir. We don't know for sure. But let me share with you what is going on with Nvidia and why it could drag S&P 500. Firstly, I've mapped out for you to see Nvidia's share price versus its profitability. Again, as an investor, we focus on profitability, which is the value it brings to you as an investor. What we would see is that 1 year ago, Nvidia's profitability had been climbing, revenue goes up, net income goes up, and the share price surged. And I don't even remember, back in June 2024, Nvidia did a 10-for-1 stock split. Markets loved it, even though it was just cosmetics. But never mind, the story continues. Nvidia's profitability continued to grow quarter on quarter. And in terms of percentage, it was very strong, quite likely unsustainable. But markets still loved it. Markets continued to trend up even though there were up and down periods. But all in all, Nvidia reached a high of $145. But something peculiar has happened that we cannot ignore. Most recently, for first quarter 2025's results, Nvidia did yet another record. Revenue all-time high, net income all-time high, although margins slipped slightly. This time round, markets punished the share price. And as you can see, I drew a red arrow. Markets did a dive from $145 down to $110. A 15% correction for apparently nothing. So what's going on exactly? From my experience on markets, I would guess that market is interpreting a peak for profitability. Many times we assume that a business does not have cycles. We may have seen the peak cycle for AI and semiconductor chips. And moving forward, growth will slow down to a point until it turns negative. Sounds crazy? Maybe not. What we can see is that Nvidia's biggest customer, Microsoft, has already started to cancel data centers and cut back on spending. Microsoft has been leading the way, as what I've shared before in previous episodes, on pouring monies towards developing AI data centers. They've committed 80 billion worth, and with them leading the charge, Alphabet, Meta and Amazon, as shown in this chart, have been also spending big to develop and catch up with them in the AI race. If you have followed this channel, you'll realize that I've mentioned before on DeepSeek, that has fundamentally altered expectations that pouring more money after AI is the only way. And moving forward, there is suspicion that there will be cutbacks on data center chips that would impact Nvidia directly. At least this is my own interpretation. You take it with a pinch of salt and decide whether it makes sense or not. Again, not a buy or sell recommendation. I'm just sharing with you my perspective for you to make your own calculations. This is a commonly seen graph of Cisco versus Nvidia. Cisco was the darling of hardware in the dot-com bubble. Nvidia is the king right now of hardware in the AI bubble. Some people say that these two are not similar. Back then in dot-com, profitability was different from right now in this AI phase, where Nvidia is really making real profits. But hype is hype. When the trend turns, profits can dry up and turn to losses. This graph was plotted until 2024. I've extended at the top further green lines to show you what has happened in the last 1 year. Nvidia has actually cracked new highs, correct? And right now seems to be tailing downwards. Many experts are saying this is a buying opportunity. Maybe it is, but personally I'm quite skeptical. If a lack of demand snowballs like what happened to Cisco, you would realize that inventory will build up and subsequently that inventory will become obsolete and need to be written off. Nobody could foresee DeepSeek coming out, correct? And that's why we always need to add a level of prudency to what we expect moving forward from a company that's carrying a burden of high expectations like Nvidia. Nvidia has carried S&P 500. You see over here, they produced 22.4% of returns for S&P 500 with its triple-digit gain last year. The rest, like Apple, Amazon, Meta, contributed 5 to 7% only, and they were of course losers in the S&P 500. But without Nvidia's contribution, S&P 500 would have looked quite ugly, correct? And we have to think of this. If Nvidia is going to go down, just like how it put S&P 500 up, it will pull S&P 500 down. At this juncture, Microsoft is also pulling S&P 500 down. And it's only Apple that's holding everybody up, just like in 2022. Again, Apple's profitability is in big question mark, and Warren Buffett has already started selling out of it. What if Apple cannot hold up the entire ship? Think about it, leave in the comment sections, and with that, let me share with you some things to think through, especially in this investing journey. Moving forward, what we have seen in the last few years is that the Magnificent Seven, Apple, Amazon, Microsoft, Nvidia, Tesla, Alphabet, Meta, they have delivered exceptional returns because, rain or shine, they grew profitability when everyone else was suffering. Everyone else means S&P 493. The gap between Magnificent 7 and the rest is still very big in 2024, but as what Goldman Sachs is forecasting, this gap would narrow at some point. More importantly, they are forecasting annual growth of profits for Magnificent 7 to drop while the rest starts to pick up. If this is true, does that mean that you should allocate more towards the small cap? Because as profit grows for them, likelihood that they will outperform Magnificent 7 is there. Next thing to ponder about. S&P 500 is dominated by technology. And the question becomes, is there a different way to invest into good US companies? Well, maybe consider this. Swap US Equity Fund SCHD. Top 10 holdings include Pfizer, whose share price hasn't been too good, AbbVie, Coca-Cola, Cisco, and BlackRock. Sector allocations are in financials, healthcare, consumer staples, and industry. There is also allocation towards energy, and you'll see over here, IT is not a big component. Could this be a complementary piece to your portfolio if Magnificent 7 or big tech firms start to underperform? Last but not least, diversify. Don't just invest in the S&P 500 like what the title is today. Diversify to equities of other sectors. But when you mention about diversify, if you choose to use a global index fund, you would realize that 72.92% is still into US equities. Top allocations are still Apple, Nvidia, Microsoft, Amazon, and Meta. How different would this be to S&P 500? 72% the same, correct? And more importantly, in this country rate at the bottom right, there is no China allocation. China has become a taboo subject. And right now, China and Hang Seng Index is outperforming S&P 500 by a wide margin. There is an under allocation towards China, and if you were to think of diversification properly, you would realize that there are merits to having some exposure there. What if China really emerges as the champion of AI against all imagination? At least that's what the market is pricing in right now, and something that I'd like you to strongly consider. The old notion that China is uninvestable needs to be relearned already. Maybe the time is now. Thank you very much for watching right to the end again. And I have a previous video that discusses about Tesla. Tesla is big in US and Tesla is big in China. But right now, their sales has fallen off a cliff. I'd like to invite you to that tutorial also because it impacts S&P 500 as well as we discussed today. I'll sign off here and see you there. Take care as always. Goodbye.